We, as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government-guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve Bank.
Where the market is pricing what the Fed is going to do next year.
There's a reason we have inflation. We just print too much money. And so, you can be pro or con the bill, but the fact is it's free money. And that's going to be difficult next year as inflation will continue, I think, to be around 6, 7, 8%.
According to the latest data, U.S. CPI increased 9.1% year over year, the fastest annual pace since November 1981. And commenting on that, venture capitalist Kevin O'Leary recently said on Yahoo Finance Live that we're not going to see a lot of relief on inflation because if we pump another $600 billion free cash into the market after putting $6 trillion of free money in, there's a reason we have inflation. We just print too much money. It's no secret that the United States has been printing money at an unprecedented rate in the recent years. But what exactly is money printing? In today's video, we'll explore what is really meant by money printing and who does it and what implications it has for the economy. So stay tuned to the last as Lyn Alden shares her thoughts on if she thinks the Fed is behind the printing out of new money or not. So let's get started. Before diving into the video, be sure to hit the subscribe icon if you're new here. While thinking about what money really is can feel like a deep dive down a rabbit hole, so it's important to have a general understanding of the concept. Let's start with what is money, and more importantly, what is modern money?
Let's say I owe you money, yeah. Or I say you know what, you get us a round of coffees and I'll pay you back later. We've just created credit.
Yes. And
that is now an asset for you and it's a liability for me. Mm-hmm. And it's based on the fact that you're pretty sure I have the money at some point, we can settle it. And that's essentially what modern money is. Most money that we know of as money is credit, right? So, for example, our deposits at a bank are the bank's liability. It's a form of credit, and they create new broad money when they make loans, and so all credit is basically all money in the current form. The currency that we know is a type of credit, and so in that sense, yes, you create it. Any two parties can create it, even us. But of course, it's much different when it's created at an institutional level. But yes, the short answer to the question is you can create money anytime you essentially make a claim that you'll pay someone back later, and then they go and mark it down as an asset on their book.
There are a lot of people who think that money is just pieces of paper with numbers on them. They don't really understand what money is and how it works. It's not just a piece of paper anymore. The modern money we know today is more of a credit. Okay, so now you have an understanding of what money is. The next thing I want to talk about is money printing, because a lot of people talk about money printing. I don't think we have ever been very clear on what exactly it is, and who prints money. What we hear is that the Fed is behind the excess printing of money. So is that true? Does the Fed print money? I mean, for the creation of dollars, yes, they actually have to print the dollars. But do they in the context where people are saying that they're just creating new money?
The Fed creates base money. So that's actually the part of why this debate exists, is that there's different types of money.
Okay.
Like we just talked about how money is credit.
Yeah.
Right? So base money is a liability of the Fed. And so, for example, a commercial bank will have bank reserves. Like where does the bank keep their savings account? The answer is at the Fed.
Fed, yeah.
And so just like how your savings account at your bank is your asset and that bank's liability, the bank keeps their savings account at the Fed, which is, again, just a ledger with the Fed, and that's a liability for the Fed.
Why do they need to do that?
Because that's how they've chosen to construct the system.
Right.
Right.
Okay.
So if you go back to, say, a gold standard fiat banking era, banks would self-custody gold in their vaults.
Yeah.
And that would be their core collateral. People could deposit gold. People could withdraw their gold. They could make loans based on the gold. But instead, we've replaced gold with mainly two things. One is savings at the Fed. So they store their quote unquote cash at the Fed. Or two, they hold treasuries. They hold, nominally risk-free securities. And those two assets form the, quote unquote risk-free part of the asset base for banks. And so the short answer is the Fed can create base money, but they can't create broad money by themselves. There are other ways to do it, but they can't do it themselves, meaning that the Fed can't put $100 in my account. They can buy treasuries from my bank and give them more cash in exchange for those treasuries or mortgage-backed securities. But they can't then go to one of their customers and just say, we're just going to give you $100 and not take anything. They can't do that. Other entities can do that, but the Fed can't by themselves.
One of the most common questions asked about the Fed is whether or not they print money. The answer is yes, the Fed does print money, but not in the way that most people think. The Fed creates money through a process called monetization. When the Fed monetizes something, it creates new money and pumps it into the economy. This new money is used to purchase assets, such as treasury bonds, from banks. The banks then use this new money to lend to businesses and consumers. Lyn Alden also highlights that the Fed can create base money, but they can't create broad money. Now, the next question is, when they do this, is it an independent action, or is it usually under some agreement, working alongside the government? Let's hear what Lyn has to say on this matter.
With the conception of central bank independence, that is legally and supposed to be a unilateral decision by the central bank based on their written mandate.
Bullshit.
So that's based on employment levels and inflation levels. That's what they're supposed to do. Now, in times of crisis, like the 1940s or 2020, you get a lot working together. Basically, whenever the system gets super high indebted, you start to get a lot of coordination, loosely or directly, between the entities. There's multiple people that have to sign off on it when you get the crazy actions. So, for example, the Fed, they're appointed by a combination of the banks and by Congress and the president, and then put into long terms. So they're directly or indirectly backed by the people in some way. Then, in order to do the outright money printing, so not just Fed actions of buying treasuries, capping yield, but actually sending money to people's bank accounts in exchange for nothing, that requires Congress, the Senate, and then the president to sign off on it. So you need it's kind of like this distributed system where you need a lot of people all to agree to do it. It's not like one person is just out there doing it.
Lyn Alden points out that the Fed has a long history of working with the government to stabilize the economy. During times of crisis, the Fed has often coordinated with government entities to stabilize the economy and prevent widespread financial damages. The most recent example of this was during the COVID-19 pandemic of 2020. That's it for today's video. Hope you get to understand the things more clearly. If so, don't forget to like and share, and subscribe to my channel for more videos on economy and market. I'll see you guys in my next video. Adios!